Hello, everyone, and welcome to the Real Science Lecture Series. My name is Scott Sorrell, Director of Global Marketing at Balchem. Today, we welcome back Brett Stuart from Global AgriTrends for a third year to take a look at the factors that impacted global trends in 2023, and he'll share his insights into the elements that could shape 2024 and beyond. Brett is the founding partner of Global AgriTrends. He was formerly employed by the U.S. Meat Export Federation as their lead economist. In this capacity, he conducted numerous research and analytical projects in the global meat trade arena, as well as advising U.S. trade officials on international meat access issues. As part of these responsibilities, Mr. Stewart conducted on-the-ground meat industry research around the globe. Brett, the floor is now yours.
Thank you, Scott. Great to be with everyone today. It's kind of fun when you flip the calendar to December and you say, okay, time to kind of reset and think about the next year and try to review what we've learned from the last year. So for me, this is kind of a fun presentation to look back and say, where are we at? And more importantly, where are we headed? As I talked to the group today, we were talking about this, and I said, if nothing else, I'm providing you guys a bunch of fodder for those holiday meal conversations. When you need something to talk about, you can randomly just start spewing out random commodity outlook snippets, right? You can sit and talk about the global commodity markets. Actually, if you get to that point in your dinner, you have failed. So let me just start out. You guys know, I think most of you know what our business is. We advise companies around the world on global agriculture market conditions. Our focus is in the protein space: beef, pork, poultry, dairy, grains markets, and it's kind of fun. I've been doing this now for 17 years, just trying to keep a finger on the pulse of the global protein markets. And it doesn't take much effort every week to find plenty to talk about. And it's kind of fun where you have the whole world to look at. Every week we have more information. And for those who subscribe, you may see our weekly podcast. My colleague Simon Quilty from Australia and I jump on and put out our podcast every Monday morning. And if you have any interest in that or want any information, shoot me an email. So what I want to do today is talk just a brief review of 2023, and then we'll dive into 2024 and beyond. And I've picked kind of two commodity spots to focus in on. You know, we could spend all day talking about global commodity markets, but we're going to talk a little bit about the U.S. beef sector. We're going to talk a little bit about the EU pork sector, and just as two highlights in that. We couldn't get to everything, but I thought those are two that are pretty interesting right now. So just a brief review of 2023, and I think everyone's well aware of stubborn inflation. And we all see that when we go through the drive-through to get a hamburger. We see it when we stop to get gas. We see it in the grocery store. We see it in the real estate markets. Inflation has been stubborn. And so we'll start off with that. Now, I have a problem with the inflation index that is widely accepted across the world. And here's why. The problem when we talk about inflation, it has a very short memory. And what do I mean by that? When we talk about inflation, we're talking about 12 months ago. So when we say prices are up, prices are down, we're only comparing to 12 months ago. We forget everything before the previous time period. So let's use gasoline as an example. This is one all of us know, right? We all stop and pump gas. So January 2020, the US gasoline price was $2.58 a gallon. COVID hits, we see all the disruption, the supply chain issues, everything, the huge inflow of money into the system. And by June 2022, gas prices are $5.01. That was the peak. $5 gas. Now that price was up 64% from the prior year. What about June 2023? This past June, we see gas prices at $3.60 a gallon. It's the green bar is the gas price. The blue bar is the inflation, right? That's a minus 31%. And so what do we hear from all politicians in power? Hey, we're in good shape. Gas prices are down 31% from a year ago. It's huge success. Well, the reality is those gas prices are 39% higher than they were pre-COVID. Do you get what I'm saying there? This 12-month window doesn't tell us the whole story. When we only compare to 12 months ago, sometimes it tells us more about 12 months ago than it does today. And so inflation has a very short-term memory. Right now, just for reference, gas prices, US average were $3.29 in October. Now, we've had a big break on gas prices, even here in Idaho. God, we finally got below $3 this last week. And so they're a little lower than that, but that 3.29 is 6% below a year ago. So with that in mind, I'm going to show you some price charts that live beyond 12 months, right? I'm going to go way back into 2020 and say, compared to 2020, pre-pandemic, where are we at? And this is a basket of commodities that affect the protein producers, cattle feeders, hog farmers, chicken producers across the board. And so you look at where we are compared to pre-pandemic. Hot roll coil steel is up 93%. And you could look at that chart and go, wow, steel's a lot cheaper than it was in 2021. Yeah, it is. But post-pandemic, it's up 93%. Diesel is up 74%. Now, beef, due to the 3-year drought we'll talk about and tight supplies, is up 59%. The real challenge for livestock and meat producers are those three right there, the feed costs. Feed costs are up, corn's up 48, wheat's up 49, soybeans up 52. And so that causes some real strain on margins. And we've seen it throughout the protein space, not just in the US, but around the world. That is a shockingly difficult thing to absorb for chicken producers, for dairymen, for hog farmers, to absorb that higher feed cost. And we're still dealing with that. So after 4 years, the heavy pandemic stimulus, which was $18 trillion globally, nations both poor and rich are reeling with inflation. Now that 18 trillion, 6 trillion of that was from the US. We dumped $6 trillion onto our economy. And I don't deal with trillions much in my personal financial statements, right? I balance my checkbook in hundreds, right? So 18 trillion, how much is 18? Well, 6 trillion, the US amount, was enough to increase our money supply 44% in 2 years. That means nearly 1 out of 3 US dollars in circulation weren't here in 2020. That's how much we increased it. And so that's drove that inflation. Now, what does this do around the world? Well, countries are struggling, right? If you're a politician anywhere in the world right now, the heat is turned up and the voters are out in the streets with pitchforks going, hey, somebody's got to fix this. Now, your options vary as a world leader. You can raise interest hikes, which is one of the tools we use in the US. That slows that velocity of money. It tempers speculation. You can try to reduce your spending and increase taxes, neither of which are popular, or impose price controls or export taxes like Argentina does occasionally. But the blame game begins as consumers feel pinched. And so if you look around the world, here's our global food inflation heat map. So US 5.7%, Canada 8%, Mexico roughly 8%. But there's some real hot spots. And of course, there's been problems in Venezuela, 414%, Argentina, 117%. The Middle East has had it tough, even parts of Africa. But even outside of those circles, look at Europe. 14% food inflation is a problem. And it is difficult, and it's not yet worked itself through the system. It's leading to political changes. We just saw Milei get elected in Argentina. That's a big reason why. When inflation's over 100% and your central bank interest rate is over 100%, I don't care who's in power, someone else is going to be in power. And so politicians are kind of on the run to say, how do we deal with this? In the US, here's our method. This is our monetary policy that we use to deal with inflation. Typically, we raise interest rates. And there you can see the rates through October. We are now at a 5% federal funds rate. Mortgages just dipped right below 8% this last week. The CPI is now down to 3.2%. We saw that peak out at 9% inflation. Now you can see historically, when inflation got up to 9%, actually it went to 14%, we took interest rates to 18. Fortunately, we haven't had to do that. You can see that break in interest or in inflation. We broke inflation back to that 3% range with those higher interest rates. And so they've done what they were designed to do. Now that doesn't mean prices are going down. It means they're only growing at 3%. So we're still rising. declining inflation rate doesn't mean that prices are coming down. It means they're growing slower, but they're still growing. And so inflation sticks with us. Now, one of the impacts of this, and when we play with interest rates, it changes the flow of money around the world by changing the value of the US dollar. If we look at just 2023, these are these currencies moving against the US dollar. The US dollar would be on the 0% axis. The challenge here, probably the biggest problem I see, is the yen down 11%. So if you're in Japan trying to buy anything from the US, particularly beef and pork, you're having to spend 11% more of your yen to get it. On top of that, our beef prices are much higher than they were a year ago. And so that's had a real impact on the flow of US beef into Japan. Similar to China, the yuan is down 6%, the won is down 6% across the board. And this is just on year to date, right? This isn't even 1 year. And so it does have an impact when we play with interest rates. And it's definitely something to keep an eye on as we look forward. It's hard to imagine this dollar weakening in 2024. I think it will hold, maybe even strengthen further. Here's one impact of that yen change. So this is the cost of imported pork into Japan. The blue line is in US dollars. So this is the average price in US dollars of pork crossing the border into Japan. The red line is in Japanese yen. And so for US pork producers, we look at this and say, wow, this is a great deal for Japan. Our pork is 10% less because of the low cost of our hog complex right now. 10% cheaper pork. And the Japanese are going, no, it's not. It's 15% more expensive. That's because of the yen. That yen rate has gone up to where they say we're actually having to pay more for your cheaper pork. So that also has a very distinct impact. Now, the real inflationary problem, and I haven't even mentioned it yet, this is kind of the problem with no solution, is labor. We have not yet even begun to resolve our labor problem in the US. And say what you want about politics, neither party seems very willing to talk about increasing immigration. Immigration has provided cheap labor throughout the history of our country. We have always had immigrants coming into the country that have given us a labor advantage in manufacturing. We're not there today. We don't have that cheaper labor supply. And so this is the price here. This is the Federal Reserve data of the average hourly earnings of production and non-supervisory employees. These would be your floor workers at any manufacturing plant. January 2020, the average per hour wage was $23.91. October, $29.19. So we have increased that labor cost 22% in 3.6 years. And I don't know how it is where you all live, but I'm in Idaho. Every fast food restaurant I've seen in the last year has a help wanted sign in the window, right? Everyone is struggling for labor. Now, it's not all labor. We've had some companies that have had some layoffs in the area. But for those lower wage workers, we just do not have enough. And so what does that do? That creates a cycle of persistent inflation. Labor is the base unit of everything we produce. There's always an element of labor to it. And so that inflation gets sticky. And we talked about what that did with that huge surge in money supply. But as commodities go up and the real estate market goes up, that happens instantly. What about everyone's wages? Yeah, that doesn't happen instantly, right? We're seeing wages creep up, but not as fast as we saw everything else rise. And the challenge with increasing wages, if you're an employer, you say, okay, the house cost went up, food inflation's up, I need to raise wages. You do that, but the problem with wages, they only go one way. When food prices come down, how many companies cut wages? Yeah, it doesn't work that way, right? So employers are hesitant to raise wages knowing that things go up and down. It really is the problem with no solution. And for this generation right here who's graduating college and wasn't in a house before COVID, they're facing a major imbalance between what they can earn and what their houses cost. If you were in a house and made it through COVID and felt that big appreciation of your house value, you're okay. For those that weren't, and it's a very small percentage of the population right now, they are really pinched. I think it takes a decade to work this through the system to where we get things back in balance with wages and house cost and inflation. What we did to our monetary system was shocking. The $6 trillion, that doesn't just balance out and fix itself quickly. And so it's going to take time, and there's going to be some frustration in the interim. Now, the question is, what about demand? What about recession? Are U.S. consumers running out of money? Yeah, but they're not there yet. This is the Federal Reserve data on cumulative excess savings held by U.S. households. And you can see there it topped $2 trillion at the peak of COVID. That's where 2 trillion of the 6 trillion went. 4 trillion got spent and leveraged, 2 trillion went into excess savings. But look at the burn rate on those savings. And it's not out yet, but you forecast that and you say, okay, you got another 4 or 5 months and that cumulative savings is done. And we're feeling it, right? And the slope may be steepening. So that's kind of the look of where we've been, the 2023 look. Now let's try to shift gears and say, where are we headed into 2024? While we're on this topic of recession, look at this headline here. Forecast for U.S. recession within the year hits 100%. Of course, in blow to Biden. There's the political spin on it. Look at the date on this. It was October 17th, 2022. So 1 year ago, just over a year ago, 100% of economists surveyed by Bloomberg Economics said we will have a recession this year, 100%. We didn't have one, right? And I would guess if you surveyed those same economists today, they would say the exact same thing. We will have a recession, 100% chance within the year. Now, economists get a bad rap, but you got to remember, economists have forecast 10 out of the last 2 recessions, right? Doesn't work on webinar because I can't hear any audible response, but think about that one. Economists rush to recession, and as long as you say, yeah, we're headed for a recession, eventually you'll be proven right. And the question is, are we headed for a recession? The indicators are mixed, right? We've never not had a recession with the inverted yield curve that we have. We've also never had a recession with this tide of unemployment. And so one of those big rules is going to be broken this year. It'll be interesting to see. My personal opinion, I'm in the soft landing camp. We may have a recession, but to me, it sure looks like a soft landing, barring some black swan event, expanding war, pandemic, fill in the blank. If we kind of continue status quo what we're doing, I think we're headed for a soft landing. But I do think it could last for 3+ years, that we just feel a little bit of stagnation, just inflation pressure, because we don't have a good answer to deal with inflation. What does that mean for our markets? Well, here's just an example in the pork world. Here's retail pork prices through U.S. recessions. And you can see we had a recession that dropped the retail price of pork almost 20%. But that recession was 50 years ago. The most clear recession to all of us would be the 2008 global financial crisis, right? That's the longest recession we've had in modern history, and that's the dark blue line. Retail pork prices increased and stayed positive through that entire recession. And so I could show you the same thing for beef. It's very similar. In fact, it's even a little better for beef. That at least retail prices aren't really hurt by recession. And so from that standpoint, I don't see a recession really wrecking or putting any more weight on the scale against U.S. beef and pork. Beef's in tight supply, pork is very cheap right now. And I think we have some cover here, unless we have something truly significant, which I just don't foresee. Now, around the world, how are consumers doing? Here's the Global Consumer Confidence Index. And it's kind of interesting that it's only out through September, but you look at those lines, most of those lines are rising, right, through 2023. Global consumers are feeling better. The problem is 100 is the cutoff on this. If you're above 100, you're optimistic. Mexico and Brazil are optimistic. I'm not sure why. They have some really tough economic data. They didn't have stimulus like we did, but they're happy. There's a pretty big group right in that 98% range. The question for me is, what about China? Well, China has a problem, and the problem in China is when you get really bad economic data, they quit reporting it. And so that's why there's a question mark on China. They said, ooh, consumer confidence is terrible. We're just going to quit reporting it. It all happened a year ago in China. It was December 7th, a year ago, that China lifted their COVID policies. For almost 3 years, they had this draconian system where they actually locked people down physically and prevented the spread of COVID. December 7th last year, they lifted everything, they opened the quarantine camps, and they let COVID run. And you can see just on consumer confidence what that did to their economy. They're still not out of the woods with their economy. The challenge for me is they quit reporting data. There was another data point, youth unemployment. Youth unemployment hit 21% in June in China. That's a problem, right? And what did they do? They flipped the switch and said, we're not going to report that statistic anymore. So we're kind of flying blind in China, and you can use commodities as a little bit of a proxy for what's happening. If you look at China beef prices, they've been in decline for a year, and they've declined every month the last 5 months straight. The Chinese economy is weak right now, and so that's a real challenge, especially for the protein industry, because they are the biggest meat importer on earth. So what do companies do with this? We know what we do in agriculture. There's the old agriculture saying high prices fix high prices, low prices fix low prices. But in the world, in manufacturing, they're doing the same thing we do. Stubborn inflation has caused these companies to say, we've got to ration output and try to hold our high prices. It is the new model. The automakers are doing it. The airlines are doing it. Everyone's doing it. They're saying, you know what? We learned through COVID, if we slow the flow of cars out of the factory, we can charge a lot of money for them. And that's what's happening. This is becoming a universal model. And who gets hit by this? Consumers, right? Everyone's trying to take this big inflation cost adjustment and say consumers are going to have to pay it. Here's some of the data to prove this. So here's US auto sales, and this is 2023 versus the 5-year average pre-COVID. Sales of cars, new car sales in the US are down 10% from the pre-pandemic 5-year average. Prices up 36%. High prices do what? They ration purchases. And so the automakers have said, hey, our labor has just went into strike against us. And so they've had to negotiate a big labor adjustment cost. And what do? We're going to slow the flow of cars and we're going to raise our prices. What about the airlines? The number of flights are down 8%. Total capacity of people flying down 8%. The airfare's up 7%. I'm in Idaho. I fly out of Salt Lake. The Salt Lake airport's up 22% on that chart. We all know energy, right? The rig count in the US down 17%, fewer oil rigs. We know what diesel and gas prices are. So that's the new system. And that's really kind of taking a lesson from agriculture is when you lose money, people liquidate, we slow, and we get shrink supplies, and we get profitable. So over to global livestock and grains. Now, this is something I find very interesting. I've been analyzing global markets for 20 years. I first traveled to China to analyze agriculture markets in 2003. It's been 20 years. I haven't seen this happen in 20 years. Take a look at what's happening around the world. Australian cattle and sheep have been in liquidation. They have shrunk that herd. Their prices have been dismal. Margins have been negative. US cattle, we're in 3 years of drought. We have shrunk the US cow herd 9%, the beef herd. Expansion has yet to begin. We'll talk about that in a minute. US hogs, financial losses 8, now 9 out of 11 months. Hogs and pigs report showed very slight liquidation, but we are going to accrue losses over the winter and continue to liquidate. US chicken, you can see the processor losses. Those publicly traded companies have been losing money 10 out of the last 12 months. Egg sets went negative in September. They're starting to tighten the supply. Brazilian cattle, our estimates are that slaughter will be down 11% by 2026. Chinese hogs, disease issues, weak demand, oversupply. They have been losing money consistently now for nearly 2 years. They will be in liquidation. They probably are right now. What about Europe? This is the second largest. China hogs, the largest hog base on earth. The second is Europe. They've had significant liquidation. They've liquidated double digits in their swine herd. Their production is now down 8% year to date. And just to show you an example of all this, so what I'm saying here is the global protein space, livestock space, is all in liquidation at the same time. Think about what that means for 2024, 2025, 2026. The world's still growing by 73 million people per year. We are shrinking global protein production all over the world at the same time. means there's probably some profit out there, right? We're going to fix this thing and we're going to learn to deal with inflation by tightening supplies and raising the costs, just like the airlines and the automakers. So let's talk about two issues. We're going to start with U.S. cattle, and then we'll talk about EU hogs. So here's the U.S. beef cow herd and calf prices. There's a cycle that I can trace back to the 1920s. It's about a 11 to 13 year cycle, peak to peak, and it ebbs and flows based on profitability, sometimes extended by drought. So we just went through 3 years of drought. You can see that big decline in the cow herd, and what has it done to the cost of calves? Calf prices have been through the roof. We've now shrunk that herd 9% in 5 years. We're going to continue to liquidate. You can see 2024 will be smaller simply because of drought. 2025 will be smaller, and maybe even 2026, because when this herd gets the smallest is when profitability gets enough that people start retaining heifers. And when you pull those heifer calves out of the system, the supplies get even tighter. And that's when we see the record high prices. We're not near record high prices yet in the calf markets. Those record high prices will probably be 2025, maybe even 2026. I think we'll see the highest calf prices in history the next 3 years. And here's why. There was the year ago drought. Here's where we are today. Outside of this one belt right there from California up into the Dakotas, everywhere else is still in pretty persistent drought. And honestly, that's kind of my stomping grounds. I grew up on the border of Wyoming and Utah. I live in Idaho. This is high desert country. This doesn't have high agriculture productivity. It's all ag land. It's all agriculture, grazing, but it's high desert grazing, and it's not really dense. And so the densest cow herd population is in Texas, Oklahoma, Nebraska, Kansas, Missouri, even Kentucky and Tennessee. The southwest or southeastern U.S. has 1/4 of our cow herd. So you can see what that's doing, right? Right now, 44% of our cow herd is in an area under drought. And what that's done, heifers as a percent of the on-feed inventory is now 40%. 40% of our herd that's on feed is female. That's the highest we've seen in 20 years. So we're still in liquidation mode. And we saw a big meltdown in the cattle markets just recently. And here's why. This is the WASDE revisions. This is the World Agricultural Supply and Demand Estimates, the report that the USDA puts out every month. And this is the expectation for beef production. Now look, this report, they started May 2022, estimating 2023, but look what happened over the summer of 2023 with the drought. USDA added 1 billion pounds of production to this year because as that drought continued, people kept pushing cattle on into feed yards. And so those heavy placements, we saw real heavy placements in September and October, really took the steam out of the cattle market. And there you can see June 2024 live cattle futures. On September 15th, they were $1.93, November 30th, $1.69. That's the contract that most of our fall calves are marketed against. And so the challenge with this is we have a lot of cattle feeders that were buying calves in August, September at those record high prices. Those calves are now sitting in a feedlot worth far less next June. And so for those who hedged, they might be intact. For those who didn't hedge when they bought those calves, they might be in trouble. This is a $312 a head loss taken out of the cattle futures. That's $56 a hundredweight on a 550 pound steer, 56 cents a pound on a steer. And so that is a dramatic drop. Now, the challenge for cattle feeders are their biggest cost, you can see here in orange, is the cost of that calf. Well, this is through the sale month of October. So this doesn't show the cost of those calves yet that are going to be sold next spring. And so that calf price, that orange area, is going to go higher than it was back in 2015-16. So as a cattle feeder, you buy the calf, you buy the feed, you buy medicine, you have death loss, you figure it all in. The area there is your cost. That line is your sales price. Now you look at this and say, who wants to be a cattle feeder, right? Every once in a while you actually make money, you get profitable. It is a tough business. Now here's the challenge. Q1 2024, there's where break-evens are going to be. we've been selling these calves or selling fed cattle. The cash price has been around that 175, 180 range here over the summer. And it is jumping quickly based on the high cost of these calves that are already on feed today. What about Q3? As we go into Q3, the cost of those calves continues, and it's not just a portion of your inventory, it's all of your inventory. We get break-evens that go up to $27.90. And so right now, the cattle futures are nowhere near these prices. We're looking at break-evens in Q1. Those break-evens are 191, 193. Fed futures is 173. Q3 out there, we're looking at break-evens around 205. Again, look out into the futures market there. Those futures are 170, 180. And so there's definitely some strain, and depending on where people sit with the risk management, there's some real risk here to the cattle feeding sector. Now, it's not just the U.S. that's doing this as well. Canada and Mexico are in drought. Both of these are big cattle producers. I was in Alberta a couple of times this fall, right in the middle of that red dot in southern Alberta, and they are liquidating herds aggressively in Alberta. That's a pretty cattle dense area. Mexico, the biggest corn importer of the U.S., cattle producer, hog producer, poultry producer, they are in trouble. And even though their president says we're going to ban genetically modified U.S. corn, they're not going to ban it this year, right? I mean, they depend heavily on U.S. corn. And I don't think that threat will ever come to pass, simply because it would end their livestock industry were they to do it. So let's see, we've talked about the U.S. cattle industry. Let's shift over and talk and I'm going to do this in one slide. I usually spend a lot of time talking about the Chinese hog market because this is half the hogs in the world. I'm going to do it today in one slide. This slide tells the whole story. That big roller coaster in Chinese hog prices was due to African swine fever. 2018, they find African swine fever. 2019, they liquidate 2/3 of their swine herd. 2/3 of half of the world's pigs liquidated within a year. And what happens? The price goes through the roof. And what happens when the price goes through the roof? Profits, right? They had profits over $300 a head in China for 10 months. What happens to a hog farmer with $300 a head profit? You breed every female you raise. You don't even wait for sows from the genetics company. You just start breeding your market gills. And that's what they did. They overproduced, they crashed that market back below break even. And there you can see for most of the last 2 years, Chinese hog farmers are losing money. Now in China, when you lose money, you don't have a farm you can go leverage to feed pigs. You don't own the land. The government owns the land. You have a lease on the land. And so your liquidity options are very limited. And this leads to a very cyclical pattern in China. When farmers lose money, they liquidate hogs, the herd shrinks, the price goes up, and you rinse, repeat, right? It just continues. Now, the challenge this time is there's been more financing available to those hog companies. And I don't know if it's government financing, private financing, but those big hog farmers in China are carrying a lot of debt. You watch and see what happens in the first quarter of 2024. We are going to hear of major financial stress of some of the biggest hog companies in the world, those mega farmers in China. And the question becomes, does the government try to bail them out? I don't think they can bail them all out. We may see one or more of those companies crash in the first quarter, but those big China hog farms are in trouble. Now, those guys are only 30-40% of the industry. The other 60% plus are still those medium and small farmers, which are still very cyclical. We are going to see something happen in the back half of next year with Chinese hog prices. And my guess is we're going to be up there in that 20-25 RMB range in the back half of next year, which when that happens, it starts pulling on global supplies of pork. That's my guess right now, back half of next year. Now, it all depends on the Chinese economy, and I have no good feel for really where that economy is other than things are tough right now. So, number one hog base in the world. Here's the number two hog base in the world, Europe. Take a look at the 2-year change in inventory. The EU swine herd is down 10% in 3 years. Every major producer declined in 2022, even Spain on a 1-year basis. Look at the 2-year change. Germany was a pork powerhouse, down 18%. Denmark down 14%. These are big hog producers, big pork exporters. The EU sow herd is now down 9%. The EU Commission came out and said, we're going to lose 10% of our swine herd over the next decade. Yeah, they've lost 9% of it in 2 years. That's going to continue. And this is all driven by, it's a basket of things. The war in the Ukraine completely disrupted their energy supply. I had European hog farmers telling me that their electricity bills went up 500% last summer. Just electricity. They've passed some pretty strict animal welfare rules. They are climate policy at all cost right now in most of these countries. Everything's about climate policy. They know they're going to shrink their livestock sector. They know they're going to reduce fertilizer usage. And they simply say, that's what we have to do to meet the climate goals. They're okay with it. And so we're going to see some big changes in Europe. I think this is structural decline. It's leading to a major drop in EU pork exports. The EU is the biggest competitor of the US worldwide in pork exports. And here you can see they are now half of what they shipped at their peak in 2021. Year to date, EU pork exports are down 23%. And even though those European hog prices have declined, here you can see the EU hogs against the US hogs. Both of us have seen our prices come down, and we still remain incredibly competitive against EU pork in the global markets. We've seen an increased market share in Korea. We're seeing a slight increase in Japan. All of our major markets are going to see growth in US market share into 2024, simply because our biggest competitor is slowly liquidating their herd. Now, if we look at the US hog market, 76, that's not good. That's below break even today. And here you can see US hog margins, the 12-month average in hog margins, where we're at, up and down, right? We go through roller coasters and it changes our breeding inventory, well, those margins. Now, in 2014, we had the PED disease, led to high mortality. We saw the highest profits in history, over $50 a head profit. COVID, we saw some weird disruptions in this chart, but look at where we are today. And this is just through September in that Iowa State data. I think we were $18 a head in October losses. So these 12-month losses are extreme in the US hog sector. And lean hog futures show losses accruing for another 7 to 8 months. We don't get profitable until next summer. So the breeding herd numbers are only showing modest declines. We're seeing, just recently, we kind of saw a big increase in sow slaughter. We will see more liquidation of the US swine herd over the next 6 months. And as we get into Q1, it may be bankers making some of those decisions, but things are difficult right now in the swine sector, and we will see further liquidation. The question is how much? So who do we blame for this? Well, you can blame the feed cost. There's the feed cost per head, farrow to finish. We were typically sub $50 per head in feed cost. We're at $73 today. $73. Now, the new corn crop came in. Corn a year ago was $7 a bushel. Today we're $4.70 a bushel. So that's a huge drop. But the challenge is that corn cost takes time from when you harvest it, blend it into existing inventory, to where you truly feel that in the hog barn. You're probably out into Jan, Feb before you really start to realize the cost improvement. And I think that'll take $18, $20 a head cost down for us, getting us closer to profitability. But still, based on existing hog futures, we really don't have a profit window until next summer. So this was all talk of the supply side, right? I've talked about liquidation, warned you out on liquidation. What about the demand side of protein globally? Demand is fickle, right? We're all good at trying to estimate supply, whether it's yield or productivity or herd size. Nobody I know can really forecast demand very well. Fortunately, when we look at the global demand, it's very stable and it grows, right? The easy answer is global demand for protein is growing on a very stable rate and has been since the 1960s. You can see here the world needs and wants more protein every year. There have been some blips where they haven't got it. The pork world, that African swine fever in China, reduced it for a couple of years. But by and large, the world wants more protein. Pretty easy to see where demand is headed. Demand is headed higher. And so Supplies are tight, demand is higher. What does that tell us about 2024? We're going to see prices improve. We're going to see a lot of the global protein industry eventually get profitable because we're restricting supplies to a world that wants more beef, pork, poultry, and seafood. Now, I mentioned the factor with hogs, the grain factor. That's the huge problem for us right now. If you look at this extended inflation on grains, feeds, and oils, feed costs remain the key driver of financial losses in this hog and poultry sectors. It has been very difficult. And you look across the board to pre-COVID, even corn, as cheap as it is today, it's still 48% higher than it was pre-COVID. Wheat, soybeans across the board, the oil, soy oil is still up 77%. So even this cooling commodity market, we are nowhere near where we were. And what I would say is we're not going back there. We're just going to have to adjust to this higher cost system. So global grain markets, the big factors are the Russian-Ukraine war. That's put a premium into the global wheat prices. What I'm telling you, the global beef and swine herds are liquidating. That has an impact on how much grain we need, right? We're producing less livestock. Energy policy, we've got ethanol and now not just biodiesel, the renewable diesel. Renewable diesel is going to be a big deal in the next 2 years. In fact, we're going to see some big shifts in how we price corn as we buy acres away from corn, and especially soy meal. We've got poultry producers, hog farmers that are already studying how do we include more and more soy meal, because we are going to likely see much cheaper soy meal the next 2 years with the renewable diesel program. I mentioned Mexico's threat to ban U.S. corn. I really don't think they're going to go there. One, they're going to have to prove to the dispute panel that genetically modified corn is a health risk. We've been using genetically modified corn worldwide for over 40 years with 0 confirmed illnesses or deaths. Secondly, Mexico needs U.S. corn. One thing that is a major shift has been China's pivot from the U.S. to Brazil. China opened to Brazilian corn back in February. We are seeing massive volumes. I mean, record high corn imports into China right now, driven by that Brazilian corn. Now, usually we ship a lot of U.S. corn to China from now out into next spring. They are buying a lot of Brazilian corn. So keep an eye on that, where it's reshaping the global corn flows. And weather, always the constant uncertainty, right? All right, just a couple things, and I'm going to get ready to wind it up. So think about any questions you have, and we'll get there. I just want to talk just briefly about China from a broad macro perspective, and also give you a rundown of some of the climate policy we're seeing around the world. Now, the problem with China is data. We don't know what data is good, what data we can trust. This is the USDA estimates for China data. And all I did is I took production divided by consumption of all of their major commodities. What's happening in China? They are losing self-sufficiency in every major commodity group, including rice. In 8 years, their rice self-sufficiency is down 9%. Corn down 28%. Beef, they have found a new appetite for beef that is not going away. They're not going to produce their way out of this. And the reality is in China, it's not that their production is terrible, it's that their incomes have grown. We know their population has likely peaked, it's going to decline in the future, but that rising income of the middle class is going to fuel this for decades. They're still going to need a lot of commodities. Now, I would tell you, this is great news for every global agriculture supplier except the US. In 2022, we shipped more agriculture in dollar value to China than we have in history. The problem is China imported 236 billion in agriculture. So when China tells you we're fine on food self-sufficiency, we're increasing self-sufficiency, remember this chart right here. They are not increasing self-sufficiency. They are going to import more and more agriculture. The challenge is, because of political friction with the US, for 10 years, they have been trying to reduce their dependence on US agriculture, and they're going to continue to try to reduce that. Now, I'm not saying China's going away. China will be our largest ag export market, maybe for the next decade. But what they're doing, they're scouring the world to try to find other suppliers that are not the US to buy agriculture commodities from. And so China poses opportunity for us, but it's a complex opportunity. This was out of the Wall Street Journal last month. They talked about this. They said for the first time since its economic opening 40 years ago, China traded more with developing countries than the US, Europe, and Japan combined. They are approving African countries as suppliers. They're approving South America everywhere they can. Brazil and China have a very cozy relationship. I think those two presidents visited each other, or their administrations did, at least 4 times this year. And what do? We continue to beat the drum saying, hey, we're going to sail warships through the Taiwan Strait. We're going to secure the South China Sea. And we want you to quit violating human rights in Southwest China. And so what does this say? Things are going to be tough. Again, China's the biggest ag importer in the world, and they will be our biggest market. But they're a tough, complex market. And we do have friction, and we will have friction in the future. Climate legislation. This is a huge thing going forward. It is not going away, but I just wanted to show you from a US perspective some of the things around the world. I was in the Netherlands in June at a conference, and honestly, I follow this stuff every week of the year. I was shocked. I came out of that conference just shocked at how completely committed in the tank they are, even their ag industry, to meet those climate goals. Now, the Netherlands, we've seen farmers protesting for a year. They came out and said, to meet our climate goals, we're going to cut our livestock in half. And we're going to reduce fertilizer usage by half. And we're okay with that. We'll import food. We don't care. We are going to meet the climate goal. New Zealand has passed a law saying that if you own a cow in 2025, you get a bill from the government. They're taxing the producer. They're not taxing the consumer. They're saying, you have a cow, you're getting a bill. One of the big New Zealand livestock groups came out and said, this will have our cow herd in 5 years. By 2030, we'll have half as many cows. Now, the good news is there was a political coalition that just formed in New Zealand that claims they're going to have the power to overturn this. We'll see. Ireland has said they're going to cut their emissions 25% by 2030. They've already said they assume they will depopulate 200,000 dairy cows in Ireland this year. That's pretty shocking, right? Denmark, they're going to cut emissions 65%, one of the biggest hog or pork exporters in the world historically. They're going out. They're reducing it. In Canada, they've had huge political drama over carbon taxes. Canada's Prime Minister, Justin Trudeau, says, I think we ought to cut 30% of our fertilizer emissions. That will cost them 160 million tons of grain output. And every Canadian will have plenty of grain. They're a big exporter. The ones that won't are the people that were buying that exported grain out of Canada. And he's proposed that carbon tax. And you can jump online, and it is a huge political football in Canada right now, the carbon tax. But it's all about methane. It's all about livestock, fossil fuels, landfills, biomass. And we all saw the Livestock's Long Shadow report that said livestock contributes more to global warming than the global transportation industry. Dr. Mitloehner is an air quality professor at UC Davis. He's done a lot of work in this space. He is convinced that livestock can be part of the solution for climate. And the real risk is that we follow legislation rather than try to use a carrot approach. There's a stick approach and a carrot approach. And the stick approach, I don't think will work. And hopefully we can see the folly of some of that misguided legislation and find better opportunities. Dr. Mitloehner's worked with some of the California dairies, and it suggested that those dairies are making more off of their manure than they're making off their milk right now. And so I think there are opportunities with climate policy, but it's something we need to tread carefully and maybe not act as rashly as some of these countries have. So just to wrap it up, we've hit on all this, right? Sticky inflation is there. I think it's going to stay. Global protein supplies are tightening. That suggests higher prices and profits out there in the future for those who can endure the present. And it's really been about feed cost inflation and weather. Threats and opportunities abound. Yeah, there's always threats, and there always has been. And there's always opportunities, and there's always has been. But let me just leave you with this. This is a quote: as you live in the news cycle, everything's a problem, right? If you listen to the news all day, you just fill your head with all the problems in the world. This is a quote by Art Cashin. He was the The guy was a legendary New York Stock Exchange trader, and he said this: don't bet on the end of the world. It only happens once, and the odds are really against it. And so, my point being, there are good days ahead. I think 2024 is going to see some good corrections, some good opportunities in the global agriculture space. Agriculture is incredibly quick to adapt and adjust to changing environments. I think there's some good days ahead, and I think it's going to be an exciting time here the next year, the next 3 to 5 years. So with that, I'll go ahead and wrap it up. Scott, open it up to any thoughts, questions.
New research is changing everything we thought we knew about choline's impact on the cow and her calf, and top scientists have a lot to say about it. They are presenting new research that supports choline as a required nutrient to optimize milk production, choline as a required nutrient to support a healthy transition, choline as a required nutrient to improve calf health and growth, and choline as a required nutrient to increase colostrum quantity. This new research is solidifying choline's role as a required nutrient for essentially every cow, regardless of health status, milk production level, or body condition score. Learn more about the science that is changing the game and the choline source that is making it happen. Reassure precision-release choline from Balchem. Visit balchem.com/scientistsay to learn more.
Brad, I think we're going to just transition right into questions. We have several to address here. I'm actually going to start with one of mine. You talked about the Netherlands and Ireland and Denmark and countries that are reducing protein production to be able to meet environmental legislation. And yet, the previous slide, you showed that protein consumption continues to rise. So my assumption is that production is going to go elsewhere. And so aren't they really just passing the buck?
Yeah, that's the debate, right, with climate policy. Is the Netherlands says, okay, we'll shrink our herd by half, we'll reduce fertilizer use by half, and we'll import from Brazil or somewhere else that doesn't really have the same policies we do. Does that solve anything? No, it really doesn't. But does it allow you to go to the climate meetings every year and say, we have met our goal and we're going to pressure everyone else to do the same? And I guess in their mind, that's their form of leadership. We're going to do it, and then we're going to try to put pressure on others to do it. The reality is, and we all know this, somebody needs to produce food. We can't do this at the peril of global food production. And I'm convinced we can do it. We can do both. We can do some things to limit our carbon emissions, and we can still feed the world. But given the choice, if you've got to let some rope slip on one or the other, you can't fail at feeding the world. That's the one thing we cannot fail at. And so that's why I think we need to tread lightly, be careful with the policies we impose.
Yeah, so kind of related to that, right? We hear a lot about people shifting from animal-based proteins to vegetable proteins. What kind of impact is that having on the market, and what do you see it having going forward?
Yeah, so 2019 was the fever pitch of the alt protein space, right? 2019 is when Beyond Meat stock hit $238 a share. All the activist hedge funds were just pouring hundreds of millions of dollars into Beyond Meat. Everybody said this is the wave of the future. The Impossible Burger came out. It was stellar. I mean, it was in Burger King. It was everywhere. It was all over the place. Every conference I spoke at that year, Scott, had a speaker on alt protein, and they showed just hundreds of these alt protein companies. Things are fantastic. It has been incredible to me to watch and see how wrong those investors were. And yeah, I'm biased. I'm in the meat industry. I've tried the Impossible Burger. It wasn't that good. But what happened, I guess the easy way to say it, do you know what? You can look up what's Beyond Meat stock price today. It was $6 a share last week. They went from $238 to $6 a share. That company is on the verge of bankruptcy. I mean, they've had executive teams have left, money flow, huge cash flow issues. And what it really tells me, Scott, it was just a flat out rejection by consumers. You need to be careful when you say, I know what consumers want. And especially when there's a little bit of a political slant to that, to say, we're going to impose this a little bit on people because it's the right thing to do. Be careful when you do that, because there have been hundreds of millions, if not billions of dollars of investment money lost chasing that alt protein space. Now, like I say, it is circling the porcelain bowl, the alt protein space is. It will always be there. There will always be a niche for that. But boy, this idea that it's going to become a big piece of the market, no chance. The consumers just flat out rejected it.
Yeah, thank you for that. Talk a little bit about supply. You were talking about the beef market. A lot of our listeners are actually from the dairy industry. And so I'm wondering, what impact has beef on dairy had on kind of the shape and complexion of the beef industry, at least here in the United States?
Yeah, it's been pretty interesting to see, Scott. It's being widely accepted now, right? And using sex semen and being able to produce your genetic maternal base with a small number of cows, and with those other cows being able to produce higher quality beef calves. Huge variable. Now, on the national balance sheet, does it change beef production? Not really, because all of those Holstein calves were being fed, and they finished well and they grade well. And so it doesn't change the numbers, but it does change the number of females. And it definitely upgrades the value of what those dairies are selling. And so dairies have realized it pretty quick. We're not just a milk profit center, we're also a meat profit center. And over the last few years, we've seen that beef price rise. This is hugely helpful for the dairy industry to say, okay, now we have calves that we can market for hundreds of dollars a head instead of tens of dollars a head. Definitely hugely helpful to the dairy space. In terms of national U.S. beef supply, it really doesn't change much. It does upgrade some of the quality of those animals.
Yeah. Brett, as always, this has been a very interesting and informative webinar. I've got one last question for you as we have reached the top of the hour. And it's kind of a broad question, but, we had what we thought was normal pre-COVID. COVID comes along, it changes everything, and it feels like we're still getting over that. So I'm just kind of curious, what does post-COVID look like, and when do we get there?
Yeah, boy, that's a good question, isn't it, Scott? When do we say, okay, we're back to normal? Now, I know people that sold their homes on that high post-COVID spike that have said, I'm going to wait for the market to crash and buy my home back. I think that's a bad idea. They're still waiting, right? Mm-hmm. And I know there's stabilization and markets correct, and there's a need for some type of economic correction. Some say it's the recession we need but don't want. But again, I don't know if this is a single event or if this is just a new world we're in. I mentioned in the webinar, I think it's a decade before we really kind of adapt and adjust and get labor and real estate, everything rebalanced to where it works. I think what we see, Scott, is no major event or no major shift. I think we're just stuck here. And I think it takes 5 to 10 years for things to kind of rebalance and get wages right with the cost of everything else. I think it's going to be a little bit difficult economically, and we're going to see some slow growth here for 3 to 5 years as we try to rebalance and adjust. We don't go back to where we were. We're not going to take $6 trillion out of the U.S. money supply. We're just going to pay more for everything, and wages will eventually correct and adjust, and we move forward. It's painful. It's a little bit difficult, but I don't think it's a quick change. I think it's a slow change.
All right. Thank you for that, Brett. Thank you for the presentation today. And thank you, everyone, for attending today's webinar. The Real Science Lecture Series of webinars continues next week, December 12th, when Dr. Clay Zimmerman will present Not All Rumen-Protected Products Are Created Equal. Clay will take a deep dive into the science that's required to make a truly effective rumen-protected nutrient. Visit balchem.com/real science for more details and to register for all future webinars. Balchem's podcast series continues to offer a deeper dive into our webinar topics. Log on to your favorite podcast platform and search for The Real Science Exchange or visit balchem.com/podcast. If you want a really cool Real Science Exchange t-shirt, just subscribe to the Real Science Exchange and send us a screenshot along with your address and t-shirt size to anh.marketing@balchem.com, and we'll get that off to you right away. On behalf of Balchem and Brett Stuart, thank you for joining us today.
Thank you.
Thank you, Brett.
Yeah.